Welcome to Markets Now. I'm Michelle Rook with Rich Nelson of Allendale, and we ended mostly higher in grain and livestock futures trade on Wednesday. And Rich, let's start off talking about the leader in the grain market, wheat. Obviously, we saw a little short covering, but how much of it was war and weather premium being added to that market?
I would say pretty much maybe half that moves, and the other half being technical or fund liquidation here. There are some valid reasons to add a light amount of support. There's quality concerns with the hard and soft red crops. Maybe a little light concern here with the current spring crop as well. We can argue a little bit Middle East premium. Keep in mind, Egypt, which is one of the neighbors to this conflict, is the world's largest wheat importer. So there are some questions there. You can argue for some higher premiums. I'm not quite sure if those stories, though, would give us all of this recent move, though.
Yeah. From a technical standpoint, did we get above some resistance levels that might trigger the funds to keep covering these short positions they have or not?
I think we can make that argument here. For instance, on the Minneapolis contract, we filled one closely followed upside intraday gap here in today's discussion and kept on going. And you can argue based on the charts, we have some prior highs which do suggest maybe another 20 to 40 cents. So there are some reasons for higher prices. From a chart perspective, you can argue. One thing I find interesting is that we can argue with these heavy wheat supplies, maybe we should be a feed value versus corn. Interesting that today's run on the wheat side was not backed up by corn, though.
So the corn market was a reluctant follower of wheat again, wasn't it?
It's certainly right. And this corn market really interesting to see is one of the most laggards right now. We're still in a downtrend for corn. We really haven't shown yet much enthusiasm to get past those new lows posted just this week as well. So we still have a lot of problems, which maybe we'll have to get through the end of this month and into that grain stocks report before we can argue for some higher pricing here.
Yeah, what's the problem with the July corn contract? There's a long list I can see. I know we have July options expiring on Friday, but you have such good demand. So what's been the problem and why have the July D spreads collapsed?
That's a really good question here. And it's actually not that out of bounds on a seasonal basis. Typically, July futures by themselves do have a downtrend into the third week of June. Certainly, that is shown on the July D spread. Typically, that drops all the way down into June 21st. So, even though we can argue the fundamentals between old crop, which are much better than fundamentals for new crop, and maybe this should have kind of divorced ourselves from the seasonal in this specific year, though, the seasonal worked very, very well and basically followed the plan. At this point in time, I'm simply going to say we have some fund liquidation, which had been in the July, and we have had to basically liquidate this over several weeks. The question is how aggressive they come back in the December, or don't they?
Yeah, and the question there will be, do we get a weather problem, right?
That sure is right. And one thing I'm going to point out is, as a person who does long-term price modeling, et cetera, we really don't even need a weather premium to have higher prices in corn. We are actually already pricing in higher ending stocks at this current price right now than what USDA is showing on their current balance sheet. So in our viewpoint, this market is pricing in an extra 300 million bushels or so on top of USDA's numbers for ending stocks unnecessarily. So bottom line is, yes, maybe the market wants a sparks, so to speak, to get a rally started. But from our standpoint, this market on the corn side is undervalued.
Okay, Rich, historically, where should we be when you have old crop ending stocks at 1.365 and new crop at only 1.75?
So if we didn't have any type of trade risk discount, this would put July futures pretty much at 560 futures, and it put December right around that 5 to 520. Even if you argue that we need some type of discount based on trade risk and trade concerns, you can still argue this market is still a bit undervalued here, even making those assumptions here.
Yeah. Corn and wheat, were we also seeing some holiday positioning?
We can make those arguments here as well. Especially our point is, we should be drying up for the most part as far as volume going into this end of the month grain stocks and acreage reports. Also, keep in mind here this is end of the quarter, so we're pretty much wrapping up this whole second quarter discussion in these coming days. So it's very likely we will have these markets kind of stabilize in these next few days here.
Soybeans, kind of a quiet day there in both the beans and the bean oil. Have we adequately priced in the higher RVO levels yet?
So in our view, there actually is still a bit more to go. We would suggest maybe this 10.80 to $11 range for November soybean futures. So that does suggest that we will take out that February 3rd high of 10.75 and three quarters. So we do look for that to happen. The question though is, do we have any further need to push past $11 past that point? In our viewpoint, maybe we'll have to more or less be stuck in neutral for a little bit period of time. Keep in mind this China discussion and which is more or less stabilized but is not improving, is still a valid reason to have some type of trade risk discount here.
Yeah. So the biofuels news or demand does not supersede or override the lack of exports from China, right?
That is exactly right. And let's kind of put this in plain speak. We can probably argue maybe a 50 to 75 million bushel impact from the biofuel discussion here in recent days, but we still have as much as a 300 million bushel potential trade risk argument here with the exports. So number one is our export issue is larger than the any type of yield declines we may have, and the export issue is also larger than the biofuel discussion as well.
Soybeans also ran up into a little chart resistance at the old highs here too, didn't they?
Certainly right here, and we're within just a few cents right now of testing those February highs, which we do expect to take out. So at this point in time, it's a market which has done a very good job in rebounding in recent weeks. Good news there. We can probably exceed those prior highs. We're not quite sure how much is left after that point, though.
Cattle trade recovered today after the collapse yesterday, but can we keep going, especially if cash trade is not steady to higher?
And that's a very, very interesting point here. Especially keep in mind, we've got wholesale beef, which has been nothing but rocketing higher this whole week. We now have cash trading just a little bit lower here in the north, and we assume also in the south here later on this week. And also, bears can point out that in the prior 2 years, the month of June did have a good peak in cash cattle and then about a 5 to 8 week break. So, bears do have some firepower here in this short term discussion. One thing I will point out, though, is we already have a discount in these futures right now. And the question is how much is really needed. On top of that, from a chart perspective, you can point out that there's gaps, intraday gaps, both below our feet as well as above our heads here. So there's a lot of arguments which suggest that we can't have a firm opinion on this cattle market here just yet.
Okay, but we have had some lower cash trade already this week, right?
We're certainly right. I've got Nebraska is trading. I've got 235 earlier on, 239 as well. Last week's live price averaged 241 on a dress basis. I do have prices setting back $4 to $8 here.
Yeah. How much risk is there of these geopolitical concerns that have been impacting the outside markets continuing to spill over at times into the cattle sector?
That's a really good question here. Now, keep in mind here for much of our economic concern argument here we've had off and on throughout the past 2 or 3 years, cattle market has not really priced in that much of a hit at all or a concern. So I'm not quite sure if we're going to see something like that here in this case as well. Our discussion here for this week also is kind of clouded because the stock market has not had this big type of break to kind of justify a cattle market concern here. So it's really confusing on a lot of different levels right now.
Yeah. We forgot to mention we also have a cattle on feed report out on Friday, right?
That sure is right here. As far as the trade expectation, we're most of the analysts are going to be right around this -2 to -6% number as far as placements for the month of May. And overall, we'll see placements since our fall weaning. They will be running about 2 to 3% lower than last year. So it will continue a general narrative of light supply declines.
You bet. Okay, hog market, more contract highs. Let's talk about the factors pushing that. It's not just cash and cutout being higher, right?
That sure is right. And we did get a little boost in terms of trade psychology on Friday. China listed another 23 U.S. pork plants available for export to China. It's quite often that these lean hog futures wildly overreact to China news. Keep in mind, it's really not going to give us any extra benefit at all in the grand scheme of things. China's buying from us has dropped every year since COVID. On top of that, year-to-date sales right now of this year versus last year, we're down 29% from 2024 levels year to date. So it's a nice psychological story. realistically, it's not something to rally from. But the market for right now is having a good boost this week, and we'll see how long it can still get out of this one here.
Yeah, and that includes cutouts closing in on $120. So that is very supportive, isn't it?
It sure is right. And there's a lot of questions, though. How high does cash hogs and cash pork need to go before it's considered a little, maybe reaching a little too far? Pork production right now is running roughly about 1% lower than last year, but cash hog prices are now pushing this +9 to +15% versus last year. So maybe this market's getting a little high for what's still a reasonable level of supply right now.
Okay, thanks for your analysis. As always, Rich Nelson with Allendale, that is Markets Now.